Welcome to Inside Economics. I'm Mark Sandy, the Chief Economist of Moody's Analytics, and I'm joined by my two trusty co-hosts, Marissa DiNatale and Chris Derides. Hi, guys.
Hey,
Hey,
Mark.
Mark.
How are things?
Yeah, doing all right.
You hanging?
Hanging in there, you know.
Hanging? You too, Marissa, you're hanging?
Yeah, I was a little sick at the beginning of the week, but
Oh,
I'm
that's
making a
right.
recovery.
You doing
A
okay?
little cough still, but yeah, I'm fine. Just a bad
That,
cold.
that's what you get for paddling in the Pacific Ocean on a regular basis.
Oh, big news there. Big news
Oh,
there.
really? What's the
I
news?
learned that Marissa has a new hobby.
A new
I
hobby.
I am not paddling in the Pacific Ocean this season. I am taking a break.
Ah,
I have taken up pickleball.
oh my goodness. Are you like a phenom in the pickleball world?
Not at all. I am horrible.
Oh, don't be modest.
No, I am really bad. I've never won a game. And usually the score is like 11 to 1, 11 to 2, 11 to 3, 11 to nothing. Yeah,
Why,
I'm
why
I'm
did you,
I'm just starting out, so I'm learning, but I have a friend we try to play once or twice a week and we just play singles right now because I'm not fit for public consumption to play with other people, but yeah, so I'm learning, but it's so fun. And
And why, can I ask why you are taking a break from the Pacific Ocean and decided to do pickleball?
it's yes, sure. Because I've been doing it for 7 years, every year for 7 years.
Uh,
It's 6 months out of the year. It's every single Saturday morning, getting up at 5 o'clock
wow.
to either practice for 3 hours or drive to a race. It's just really very onerous for something that is a hobby. So I just need a break from it, both mentally and physically.
Got it. Got it. Makes sense. I think Chris did that once with his bocce ball.
He was getting bocce elbow.
Yes,
Yeah, you got to be
getting
careful.
bocce elbow. Yeah, exactly. Yeah. And that was a therapeutic year off, wasn't it for you, Chris?
Absolutely,
You
absolutely.
came back and were,
You know,
powerhouse.
I'm on top.
Okay. Talking about a powerhouse, did you know we won a major, at least I think it's major in our world, forecast accuracy award? Did you know this?
Yeah, big
Yeah.
news.
Heard
Yeah.
a rumor. Yeah.
You heard, oh, you heard a rumor. Yeah. Marissa, you want to tell us like what happened here?
Yeah, I hope it's true because I reposted it on LinkedIn. We won
Uh-huh.
for the United States and three other countries, but the US is the big deal. Most accurate forecast over the last 2 years for US GDP and CPI from consensus economic forecasting. So we submit, there's a bunch of private sector forecasters, right? Submit their forecasts every month and consensus tracks those forecasts for accuracy over the years. And we just won for 2024, but really it's over a 24-month period. So that's a really big deal. I think Chris said the last time we won for the US was 2018.
Mm.
That's right.
So it's a GDP and inflation
That's right.
over a kind of a rolling 2-year period. So that
Yep.
would be 23 and 24, I guess. Right. And the previous
No.
time we won would be, I guess, 2017 and 2018 pre-pandemic.
Yeah, they go from so it went from January 23 through December of 24 over that
Okay.
period.
Got
Yeah.
it. Got it. Got it. Well, Chris, do you think that's a big deal?
That's a big deal.
It is?
Yeah.
Yeah.
It's an award.
Yeah.
Aren't all awards
Yeah, we take them, right?
yeah, absolutely.
Yeah. Why do you think we won in 23, 24? What's behind the win, do you think? I've got a few ideas, but just curious what you think was behind it.
Skill,
Skill.
insight,
Yeah. Yeah.
intelligence,
I thought you were going to say the chief
Charm.
economist
charm.
who refused to put a recession in the forecast. No?
I bet that
Of course,
yeah.
there's also luck. I should mention.
There's luck. Totally, totally. Yeah. I mean, I think though the reason 23, 24, that was obviously a period when most economists were saying recession, right? Which would be consistent with historical experience in the sense that, we had the period of high inflation in 21, 22. The Fed started jacking up interest rates, aggressively raised rates in 2022 going to 23. The yield curve inverted. And if history was any reasonable guide, I would say recession. And most economists said recession and put it into their forecast. We did not, do that. That you can go back and listen to the podcast in that
Yep.
period and get your fair dose of reasoning as to why we didn't. But most fundamentally, I'm guessing. I don't know, but I'm guessing that's why we won, right?
You can see, actually, they have a cool chart on their website that shows us, our forecast, us, our forecast for GDP tracked against all the other forecasters.
Huh.
And that's true. We're significantly above kind of everybody else, particularly in 2023
Oh,
and
interesting.
into 2024. So it was kind of like we were always up here and then everyone sort of came up to match us by the end of 2024 because they were all like the average growth rate as of like July of 23 for GDP that other people were predicting was 0.5% year over year. And we were at above 1, so we were double that.
Oh, interesting. I have to go take a look at that. I didn't look at that.
Yeah.
Yeah, I guess even more fundamentally, I think we have a process, right? A forecast process. We have a large scale model that uses to try to account for all the different forces at work, and there are lots of different countervailing forces at work. And I think that we have I sound a little bit like an advertisement, and I guess it is. A process, which, I should mention, we have a guest coming up here shortly, Richard Barkham of CBRE, the large commercial real estate firm. We'll talk a little bit more about this in that conversation, but we have a process where we have to be, if we're making any major changes to kind of our underlying assumption or forecast, we have to be highly confident in that. So it reduces the odds that we get what I call whipsawed in terms of the forecasting, which was in that period certainly very easy to do. So that process, and we got a great team of folks. Obviously, we got economists focused on all the different aspects of the forecast, and Scott Hoyt does consumer, Mike Brisson does auto. We got Martin Worm doing monetary policy. We got Justin and Brendan doing fiscal. I can go on and on and on. They're really focused on their sector, so I think that really helps as well. But Chris, I think you just said this. I think a big dose of this is just luck, don't you think?
There is some luck, certainly.
Yeah.
Because of the policies and, there are other aspects of the forecast that go beyond the data itself, right?
Right. Well, I was going to say the one thing that I think allowed us to get through without a recession, or one big thing that allowed us to get through that period, 23, 24, without a recession, despite the run up in rates, was actually the surge in immigration. The surge in immigration, it had all kinds, I've said this many times in the past, has all kinds of costs, economic and, as we can see, political. But the one benefit was it added a lot to labor supply when the labor market was very tight and the Fed was jacking up rates in an effort to cool things off. And because of all that immigration and all that labor supply, it allowed the Fed to forestall even more aggressive rate hikes. And that was probably a key reason why we kind of navigated through without actually experiencing an economic downturn. And we did not, nor did anyone, expect the kind of immigration that we got. The number of people that came across the southern border, I think I'm making this up, but I think it's right. In 2023 was like 3 million people. Typically, we get 1 million immigrants, legal, illegal. We got 3 million plus, and it came in in 2024. President Biden passed an executive order making it more difficult for asylum seekers, and that brought things down. But still, even in 2024, we had a high level of immigration, and that really helped and allowed us to kind of navigate through without that downturn. And again, that's not something we predicted. We didn't expect that, but that's what happened. Does that resonate, Marisa?
Yes, absolutely. I mean,
Absolutely.
that certainly changed the game in the labor market, right? I mean, it's the reason why we saw job growth as high as it was and had this sort of seemingly endless supply of labor for employers to draw from. So, and now we're on the backside of that, and we're seeing what awaits us for the future with much lower levels of immigration. But yeah, I mean,
Right.
it certainly helped.
Right. Right. And you
Helped with
don't
wage pressure, right? So that went right into inflation as well.
Right. Right. And I of course, the chief economist had a lot to do with this. I just have to say, no.
He did.
Yeah.
Of course, of course.
What else
As
can I
well as
say?
the rest of the team. Right?
Yeah, as well. Yeah, great team. Rest of the team. Okay. Any more else on that win, that award that we won? Any other comments on that, Chris? Anything else?
Yeah, I think it's a great achievement, but the luck is
Yeah, luck is a big
part of
part.
it. And I would emphasize, of course, I think it's the process and the scenarios. I always love the scenarios, right? That
Yeah.
really add a lot of the value. And unfortunately, I don't know that we evaluate scenarios to a great degree, but I think
Certainly,
that's
at a time like this, I don't know how else you operate unless you have scenarios. I mean, goodness gracious. I mean, the future revolves around the tariffs. How high, how long,
yeah.
which countries, what's the retaliation. Good luck with that one. Talk about luck. Whoever wins the forecast award for 2025, that's going to be what? Just 90% luck getting that right, I think.
Unless it's us again, and then
Unless it's us again. Yeah.
yeah, then it's
Yeah.
50% luck and 50% economic forecasting acumen.
Yeah, exactly. Exactly. Anyway, okay. Well, anything before we bring Richard into the conversation, guys? Any other issues, topics, that we want to talk about before we bring him in? No, Marissa,
I don't think
Chris?
so.
Okay. Well, let's bring Richard Barkham into the conversation.
Good to see you, Mark, and I'm looking forward to being interviewed by somebody more nerdy than I am.
Is that a possibility? Is it more nerdy than you are?
Yeah, I mean, you've dived in, your degree of enthusiasm for data is right up there.
Are you excited about next week's data, Richard? But
Moderately, yeah.
Yeah.
There are things in my life as well.
Yeah, right.
Congratulations.
Okay, congratulations. Richard, Senior Economic Advisor at CBRE and formerly Chief Economist of CBRE, which one of the largest. Are you the largest or one of the largest?
We're the world's largest real estate services company, and we're I think about Fortune 120, something like that. And
Wow.
we provide brokerage, property management, fund management. If there's any service that occupiers and investors need in commercial real estate, it's kind of what we do.
In CBRE, it's an acronym for. It used to be an acronym for something, right? Do you remember what it is?
Yes, I do. The CB is Coldwell Banker.
Coldwell Banker, right.
Which is an American brokerage company originated in the early 20th century in San Francisco. And the RE is Richard Ellis, which is also what we would call a chartered surveying or a property consultancy company that goes back to the mid 18th century. So it's quite a venerable corporate identity, I would say.
And how long have you been at CBRE, Richard? How did you maybe you can just give us just an open-ended question. Very curious about your career and how it progressed and how you got to be chief economist and senior economic advisor. How did that happen?
Well, I mean, I've been with CBRE for 11 years, and
11 years.
I joined as chief economist in 2014, and in 2017 I became I moved to the United States and I became global head of research, and the CBRE research team is 600 or 700 people strong. So I was managing a big department. But prior to that, I started my career as an academic. I did a PhD in economics at the University of Reading in the UK. Actually, my PhD was on entrepreneurship and new business creation. But I was teaching real estate economics to make a living as a graduate student, and I became more interested in that. So I transitioned into lecturing in real estate finance and economics, and I transitioned from that into providing consulting services, on a part-time basis to, what was then the booming London market. And by, my mid-30s, I got fed up of my students going to higher paid jobs than I actually had as a professor. And so I moved into the private sector. And I went to work for a fascinating company, a big private real estate company called Grosvenor.
Oh, sure.
Which is the private property company of the Dukes of Westminster. The core holdings are Mayfair and Belgravia. That company's got a 300-year history. And I had a very happy 14 years as chief strategist, chief economist, and latterly as a director of their fund management business. So always, practicing real estate economics. And as I say, in 2014, CBRE asked me to become their chief economist. And that's probably in real estate economics the biggest job in the world. So I took that up with great.
It's a very large team. How many folks kind of in your world across the globe? Because you're across the globe.
Yeah, I mean, as I say, in the whole research team,
Yeah.
It varies over the cycle, but anywhere between 600 and 700.
Oh my gosh, I didn't realize.
Including, probably 20 professional economists.
Wow.
In and amongst that, and a fair smattering of PhD qualified economists as well.
Right.
And we've got a full global. We're not macroeconomists by specialization, but we've got plenty of expertise in macroeconomics, and we translate that into real estate forecasts around the world.
Well, I think your accent may have served you very well in your job. It's a kind of like a James Bond-ish kind of accent. Would you agree?
Well, I mean, that's for you to say and me to continue to enunciate, I guess. But I haven't.
You'll take it though, James
Yeah.
Bond. How can you not take that?
No,
I'd run with it.
I'll take it. Yeah, I'll run with it. Absolutely. And it served me well in the United States anyway.
Absolutely. Is it where in the UK are you from? Where's that accent from?
Well,
Is it London? Is it or
it's just I come from the south of England, but I lived
South of
for
England.
30 years in Oxford.
Oxford?
So
Okay.
there is a sort of Oxford English. I'm not certain mine is quite that, but I would say I have a neutralish accent by British regional standards.
People can't pinpoint where you're from.
No, that's right. Matter of fact and classless.
Definitely James Bondish in my view. But well, it's good to have you. And I thought we could just start kind of with the broader, let's call it macroeconomic picture, just to get your sense of the lay of the land. How are you? It feels like the world has changed a lot in the last few months, few weeks.
Days.
Yeah, exactly. How are you thinking about things? How pessimistic or not are you?
Well, I'm fond of saying, to folks, when I joined CBRE in 2014, I used to refresh my deck with new ideas every quarter. Then during COVID, we moved to sort of refreshing the deck every month. And now I almost, when I'm speaking, I have to have my analyst refreshing my deck in real time, in order to stay current with what's going on. It's changing so rapidly. But just getting down to the kind of basics of the economy, I mean, there's a lot of noise out there, but I don't think we're in recession yet. All of the kind of real-time indicators are holding up reasonably well. Consumer spending, it's more difficult to get a read on business spending. But the sort of kind of high frequency data that we got used to using during COVID, such as pass through airports, which is quite sensitive to economic conditions, seems to be holding up. There's been a little bit of a dip in eating out. But I think, we're not in a recession yet. But as I think, you've clearly observed, and most people observed, that the confidence indicators have dropped like a stone. So, for all that we're not in a recession, if the uncertainty doesn't ease, and we have the full impact of tariffs feeding through into prices, in the May-June period, then we're looking at a much slower second half than we had thought at the start of the year. Maybe not a recession, maybe something closer to stagnation, but definitely a slowdown in GDP in the second half if the uncertainty doesn't ease and the effective tariff rate doesn't drop through negotiation.
So Richard, kind of a popular way of economists communicating kind of their perspective on the world and where we're headed is what probability would you attach to a recession starting at some point, let's say this year? And let's just focus on the U.S. because obviously there's a lot of things going on overseas as well, but just on the U.S. Do you have a probability in mind? I mean,
yes, and it's been moving up over the last month or so. I would probably think 50-50.
50-50
in the second half. Yeah, I think we can still get out of this situation without a recession. But clearly, that's contingent on progress being made in trade deliberations, and then that feeding through into a lower level of some higher, it's better sentiment numbers, with possibly also some cuts to interest rates.
Hey, Cris,
I think which are possible. I think that they are possible, and we could get out of it, but
could get out of it. So 50-50.
mhm.
Cris, where are you on the probability of recession? Might as well do that right up front since we're talking about it already. I'm just curious. And what was it last time we chatted, and what is it now?
It was 50-50, and you booed me. And
Boo.
exactly.
I don't do that to the guests. I only do it
I
to you.
noticed. I noticed. It's very kind of you.
Yeah. Yeah.
But I bumped it up now to 55.
55.
Oh,
Okay.
why did you move it up?
Things are not going well on the trade negotiation front, at least from my perspective. Who knows the reality, but
There's a lot of discussion that maybe there's some kind of resolution or deal or cut the tariffs, but so far that's
and then
just
it
talk.
gets immediately reversed.
Yeah. Right. So
And I also
55.
fear that even if the we get a deal, it's still it's going to be a substantial increase in the tariff, right? I don't see
Yeah.
any deal that's taking us back to where we were, certainly.
Right.
So some
Right.
of this may
Totally.
be already baked in.
Some price increases and some disruption to supply, shortages are coming, regardless
Yeah.
of what happens here. Yeah. Hey, Marisa, what about you?
I'm sticking at 60.
60?
Yeah, as of yesterday, maybe would have moved it down when I saw, or 2 days ago when I saw the news that perhaps Chinese tariffs were coming down, but today the news is that isn't happening and there is no negotiation going on. So I'm just sticking with 60. And we're also seeing data now, right, on shipping and pricing and stuff like that does not look good.
Does not look
Right.
good. Yeah. I'm at 60 as well, and that's where I've been, 60. Hey, Richard, let me ask you, this may be a little unfair, but I'm just curious, kind of a forecast philosophy question. I'll let you know how we approach this, and I'm just curious what you think. So, in our baseline forecast currently for the U.S. economy does not have a recession built into it. We are assuming that the administration takes an off ramp here on the tariffs, soon in the next week, 2 or 3, 4 maybe, and de-escalates the trade war. And to your point, we haven't really seen anything show up, certainly not in the labor market. We can make our way through. But you could just heard me just say, and Marisa and Cris, all of us are above a 50% probability in terms of a recession. So, our philosophy has been that if we're going to make a major change in our forecast, and I would say adopting a recession is a major change, and major change in any assumption, monetary policy, fiscal policy, whatever it may be, we have to be very confident in that change. because we don't want to get whipsawed, back and forth. We've got clients like you, we don't want to get whipsawed. So our subjective probability for making a change is 2/3. If we feel like a recession has a greater than 2/3 probability, we will adopt a recession forecast. Does that make sense to you? Does that resonate with you? How would you think about that?
Yes, it does. I mean, I like the high bar that you set for adopting a recession. I mean, I think sort of theoretically, if you had a set of outcomes and you probability weighted them, then you probably ought to be moving to a recession call if you're anywhere above 50% on the likelihood of a recession. You've set the, so you might be part of a consensus that is even now refusing to actually articulate what is actually what is actually happening, because you don't want to be calling wolf or calling sort of 7 out of the last 4 recessions.
Right.
I think sort of intellectually, if you're above 50% likelihood of a recession, depending on what your sort of tail scenarios are, you probably ought to be moving to that as a central case.
Right. Yeah, I guess we actually do put pen to paper, produce a forecast across everything that we do once a month around the globe, regionally, so forth and so on. And we do it right after the GDP number comes out. So next week, as I said, we get GDP, so we'll be doing the forecast again, and we'll have to rethink all this. But at this point, we would still hold to a non-recessionary baseline because we still aren't, especially in the current context, because the level of uncertainty is so high because it's so dependent on what the president decides to do or not do on the tariffs, right? I mean,
yes, but not just that, but also the spending bill. I mean, I think we've got to factor in potentially stimulus coming through later on in the year through the spending bill, and combined with maybe not a complete wind down of the trade war, but a move to a kind of sort of more medium term tough position, but negotiable position, then I think we might be able to get through it. I think that's what I'm thinking. And to a certain extent, we'll get to this in a moment or two. I talked to my team yesterday. I'm shocked really by how strong some of the consumer-related real estate data is. For instance, Q4 multifamily net absorption and Q1 multifamily net absorption are just astonishingly strong. So, that speaks to me. Real estate data is lagged, and it's not, it reflects conditions, but you just don't get that sort of real estate data unless you've got some real robust kind of consumer sentiment and fundamentals, wealth and income effects, which we underestimated, I think, in 2024, and I think might give us the momentum to see us through.
Oh, interesting.
Some of the the negative headlines.
Right. I mean, so what you're saying is the data. You said multifamily, and did you also say retail? Is that the
No,
other?
I said multifamily.
You said
that
multifamily.
Well, I think multifamily Q4 was possibly one of the strongest absorptions on record. And in Q1, I think for the first time since 2001, every market in the country showed positive net absorption in apartments. And that's tells me something that about the continued resilience of the consumer. And I'm kind of using that to weight my thoughts on where the macroeconomy goes.
Yeah, just to push back a little bit. Of course, that's in the rearview mirror. I guess you said that.
Sure it is.
Yeah.
Real estate data is always lagged.
Yeah.
But it was only 2 months ago, and
Right.
don't
You're saying it doesn't change that quickly. Things like that. Yeah.
I
Right.
don't think so.
Right. Right.
To some of these relationships, as well as I do, you've got leads and lags within kind of all of these indicators, and they're time varying as well. So, you know, the
Right.
lags that applied 3 years ago are not the same lags that apply now. So you've got to apply a little bit of judgment to it. But conditions in apartment markets are very robust. And that tells me something about, you know, where the consumer is actually at.
Huh. Well, let's turn to the property markets, the commercial real estate markets, and maybe we can look at it through the prism of the macro. You know, we've got all the trade war. It's already affecting, as Marissa pointed out, trade flows. I mean, the tariffs that the U.S. has imposed on China and the counter tariffs the Chinese have imposed on the U.S. have really, it does look like, if you look at all the shipping data, it's really doing some damage to trade, and it is hurt confidence and sentiment. It hurts. It looks like it's hurt travel. You know, certainly foreign travelers coming into the United States. From that prism, you know, what property types, what regions should I think people be most? Do you think people should be most nervous about? Or do you have a higher level of concern of some areas and some property types as a result of all that?
Slightly, yes.
Yeah.
I mean, I
Mhm.
think if we were I mean, and remember that, you know, trade is only 15% of GDP, and
Mhm.
you know, goods are only 36% of consumer spending. So, you
Mhm.
know, let's not entirely view the US economy
Mm.
through the lens of trade, because
Okay.
it's a big kind of, you know, standalone economy. However, you know, the property types, you know, the four major property types: office, industrial, retail, and residential. I mean, I think the two property types that are most exposed to the trade tensions would be the industrial sector, and also the retail sector. And I think, you know, the industrial sector, you know, and I'm not talking about manufacturing here. I'm talking about industrial and logistics. The majority of what we call industrial is kind of logistics,
And warehousing and that kind of thing.
warehousing, you know, either
Yeah.
big hub warehousing or kind of last mile warehousing. That had been slowing up, I think, even before trade tensions emerged. We've still got a fairly decent level of gross leasing, but you know, a fairly weak level of net absorption, if I can make that distinction. And I think,
Is that because people are giving back space? You know,
yeah,
yeah.
that's
Okay.
right. I mean, I think, you know, you've got really, if people are leasing more space than they're giving up
Yep.
in aggregate, then you've got positive net absorption, and generally speaking,
Right.
vacancies coming down. Yes, I think people were, you know, we had a sense, I think, and I was hearing it from around the world, that the industrial users maybe had overexpanded during the COVID era. And that, you know, trade was kind of normalizing into a kind of post-pandemic phase. And, you know, whilst industrial users or logistics operators were leasing new space, they were giving up old space. And I think so there had been a little bit of a slowdown in industrial leasing. And I think industrial leasing is probably the sector of one of the sectors of the market where occupiers have become a bit more cautious.
Mhm.
So, you know, I
I
think,
suppose particularly around ports, right? I would guess around LA, Long Beach.
well, not
No,
necessarily. I
not
mean,
necessarily.
you know, there was a pull of inventory in to try and escape tariffs. So, you know, actually the ports have probably experienced some reasonably buoyant conditions due to sort of inventory coming in. But yes, you would think that
Dead ahead.
yeah, that ahead. You know, I'm hearing that kind of Southern California industrial is pretty much, you know,
Mhm.
ground to a halt now in terms of
Mhm.
new leasing. So I think the industrial sector, you know, it was doing okay, but it had contracted a little bit on 2024, and that's obviously exposed. And of course, the retail sector. Now, the
Mm.
retail sector oddly enough, given, all of the negative headlines about retail since, e-commerce really started booming in 2015, 2016, retail's actually been very solid in terms of fundamentals. The retail sector at the moment has got the lowest vacancy rate, with vacancy at about 4.5%. So we haven't built much retail space for about the last 15 years. And grade A space is in extremely short supply for retailers. But I'm beginning to think that retailers. Well, I'm beginning to hear that retailers are becoming very cautious on new leasing, and we may see an uptick in retail vacancy from a pretty strong position of about 4. I don't know what it will go to. We haven't quite put our forecast in. And 4.5% is extremely low vacancy. Industrial's closer to 7%. Just for comparison. But I think the momentum of leasing activity in those two sectors is slowing up quite quickly, and would be expected to stay slow during this period of trade tension.
You didn't mention hotels and kind of leisure hospitality. I would think that would also be quite vulnerable here, no?
I think potentially yes. But for the last several years, I think Americans really have been going overseas. So there hasn't been a huge insurge, because the dollar's been so high on US hotels. And I don't know that they're going to particularly suffer. I mean, we are hearing that kind of Canadians are staying at home and not coming to the States. But I think the sector I don't think has been pumped up by kind of it's got used to dealing without foreign tourists going back to COVID when the Chinese stopped coming into the West Coast. I think that the hotel sector is reasonably okay, actually. And it doesn't have a big supply, because of the expansion of the short lease market, Airbnb, so on and so forth. There hasn't been a lot of new hotel construction.
Well, I have to say, you sound, just to my ear, kind of sanguine. I mean, yes, there's risks. Yeah, there's going to be some pressure coming from all the trade war and everything else, but generally sanguine. What would it take? Did I get that right? And if so, what would it take for you to seek in the property markets to make you feel change your mind that, oh, maybe this is going to be darker than I thought?
Well, sanguine, yes. I mean, when I talk to my team on the ground, I still get the impression that real estate fundamentals are in pretty good shape. I mean, the press has covered offices, quite extensively over the last 4 or 5 years, and there we have actually had a vacancy rise from 12% to 19%. So there has been a big hit to office fundamentals. Although I'll have to say that office demand has come back quite nicely over the last year. But if you think that office is 25% of overall retail, and vacancy rates are at about their long run average, the majority of real estate is quite healthily producing income. 95% of real estate is. We've seen with the rise in interest rates that happened in 2022, values have fallen 25%. But the majority of US real estate is generating positive net operating income and is in, I would say, robust good health. So, if I sound sanguine, it's because that's the reality. Whatever you read in the press, that's the reality. US real estate is in actually good shape, but of course, real estate, is a derived demand. It feeds, with lags. It's going to be dependent on the macroeconomy. If we get, and there's pretty close relationship between real estate vacancy and unemployment rate. So if we see some of the if we see unemployment rising as a result of corporates kind of corporates have been quite quiet, I think, over the last 24 months. They haven't been hiring, but they haven't been firing either. If they have to take action to preserve their earnings, then we could see unemployment rising, and I think that would begin to choke off apartment demand, probably begin to choke off some office demand as well, albeit there is a pent-up demand. I mean, people didn't do much for 4 or 5 years in offices, and there's a lot of pent-up demand there.
So kind of my narrative for the CRE market is that if you go back a couple, 3 years ago, it was all hair on fire, CRE doom loop, kind of discussion that abated over the last year or so as the economy performed well. We got a lot of jobs. We got, as you pointed out, consumers doing really well. Travel had picked up. And it looked like interest rates were coming in. The Fed had started to ease interest rates, and there had been strong expectations that they would continue to ease, and then even potentially long-term rates would come in. And as a result, if there were, some CRE properties that were having trouble making payments on their mortgages, that the banks and other sources of capital that provided that credit, were willing to work with the owners of these properties, kind of manage through these issues, because they knew that with a better economy and lower rates that it would all work out. But here we are now, and everyone must be asking themselves if that kind of narrative still holds. The economy is going to weaken, I think. It's just a debate to what degree. As you say, 50-50 recession. Even if we don't go into recession, that's a much weaker economy, less consumer spending, fewer jobs, less movement of goods, all the things that drive demand for commercial real estate. And now you've got the Fed saying, I'm not cutting interest rates, at least for a while, until there's some clarity around, what's going to go on here with the trade war. And does that mean inflation? Does it mean, slower growth? Long-term rates have backed up. They haven't risen a lot, but there's a lot of concern that they could, given what's going on with regard to the trade war and Fed independence and everything else. So, long-winded way of saying, will banks and other creditors continue to show the kind of forbearance and willingness to work with owners to make sure that there aren't defaults? Will that change, and will we see a more substantive pickup, significant? There's already been a pickup in delinquency and default. You can see it in the commercial mortgage-backed securities market data, CMBS data. But will we see a bigger pickup in delinquency and default, even if you're right and we're 50-50, we don't go into recession? Is that something we should be worried about, or is that still, you're relatively sanguine about that kind of scenario playing out?
Well, I talked to some of our and we have a debt business. The banks are still lending to real estate, and I wouldn't say aggressively, but I think the appetite on the banks from the bank to lend to real estate is still pretty high. And since the trade war erupted, I'd expected risk spreads to move out, and they have to a certain extent. But the spreads on real estate lending have maybe moved out 10 basis points, 15 basis points. So the spreads on real estate lending are about 150 basis points. The all-in cost of debt for prime grade real estate is still below 6%, and when buildings need to be refinanced, it's very competitive. Banks are lending. So that's just an immediate market snapshot. It's not answering your question completely, but the broader situation that we've seen kind of referred to for the last 4 or 5 years, the wall of maturities.
Yeah.
A lot of kind of real estate lending that was extended at the peak of the last cycle, 2019, falling due. And it's been, what we've seen from the banks is just a willingness to, even if values have dropped, even if values may be actually below the level of the loans, as long as the properties can service those loans, the banks have been quite willing to extend the loans. So, borrowers, have maybe in certain cases had to put more cash in. Maybe the banks have got creative and put some sort of, preference, equity in. But I think the general feeling I'm getting is that will continue, that this wall of maturities will never actually kind of tumble over, that we will continue to work our way through, the refinancing of US commercial real estate. And I think it goes back to the point that I made earlier. There's a problem in the office sector, which is, that rise in vacancy from 12 to 20, to 19%, and the functional obsolescence of a portion of US office stock. But you've got to remember that the office is only 25% of commercial real estate. Multifamily or apartment is a much bigger sector now, and that is in robust good health. So I think the fact that the majority of US commercial real estate can continue to service those loans, augurs well, I think. And I suspect behind the scenes, the Fed has also been watching this very closely, and the regulators, and have told the banks, not that, I generally don't think the banks have been through this before in the great financial crisis. They don't want a ton of office back to them. They don't want to manage it. They don't want to dispose of it. They just don't want to deal with it because they've been through that before, and it's a waste of their time. And I think, even owners where, kind of high vacancy offices, they don't want to abandon that because, they'll be in hock for kind of, waste management fees and taxes. So there are all sorts of incentives to try and work through this in a way that I think means that we call it extend and pretend, but I don't think on even a mild recession scenario that we're going to see problems in the real estate sector feeding through into the banking system and creating a credit crunch. And
so no doom loop.
No, well, just nothing's impossible.
Yeah.
I mean, you've probably noticed the top 50 banks, I think, over the last 24 months have provisioned about 150 billion against losses on securities. But I think
they're ready if it happens.
They're ready. I suspect if there was a severe recession and unemployment went up, we might have further problems in the community and regional banks. Because albeit that they've been cleaning up their balance sheets as well. So they've been selling loans, they haven't been idle, but I don't know that they've got the capital reserves. So I think if we started to get unemployment moving, if unemployment goes up from 4 to mid 5s, then I think we get through this with more extend and pretend. If unemployment moves up to 6.5% and we get, some quite serious move upwards in retail and, apartment vacancy, then I think that begins to become a problem for the regional banks. But I wouldn't, I'd be putting that at a relatively low probability event, 10 to 15%.
Got it.
Hey,
Cris,
the bulk of the probability is just on continue to muddle through.
Yeah. Hey, Cris, I know you watch the credit statistics carefully. Have you noticed any kind of change there, or is it still, as Richard called it, extend and pretend and kind of manage through?
Yeah, I'd say to a large degree that's the case. You can see the maturities just keep getting extended out. Right.
Yeah.
I did have a question though.
Okay, yeah, far away.
Regarding the functionally obsolescent component of the office market, as you put it. How do you see that sector being worked out? There's a lot of talk, of course, of conversions. Are these teardowns? What's your sense of how this is resolved?
Yes, I mean, it's a rough and ready estimate. But I think, I think probably 10 to 15% of the US office sector won't will have to be repurposed or torn down. That's a lot of real estate. That won't happen overnight. We're seeing conversions surge. But even now, there hasn't been, I think, enough drop in value to make, a whole scale conversions pencil out. And I think with rising, one of the areas that I think that we haven't touched on, with tariffs and trade war is just going to push construction costs up. So, that's going to put a brake on any sort of new development. So I think that would slow the conversion process. But I think, this is going to take 2 cycles. This might take the best part of 20 years to work out, alternative uses for that functionally obsolete office stock. And, it is happening. The conversions are ramping up quite quickly. But even so, I think, at 1% of the stock per annum, that still gives you a 15-year. And that, as I say, is it's a two cycles to get that resolved.
Let's end the conversation around another concern, potential concern, related to recent events, and that's inflows of foreign investment. So, obviously, foreign investors are a key part of the commercial real estate market. And there's been a lot of hand wringing about investor demand for U.S. assets in the context of recent events. This whole concern about the U.S. safe haven status. Money comes flowing here when times are tough, and that doesn't appear to have happened. It doesn't feel like capital's fleeing, but it doesn't feel like capital's been coming in. You can see that in treasury yields. Certainly, the value of the dollar is down, which would not be consistent with capital coming in. Have you noticed anything in terms of foreign investor interest or demand, in the current environment? Has that waxed or is that still as strong as it's ever been? Have you noticed anything?
I think in general, around the uncertainty, all investors are on the sidelines for the moment. I think we started the year with pretty positive investor demand, and that included from overseas. But I think, investors don't like the uncertainty. So it's difficult to distinguish with all investors on the sidelines whether you've got some overseas aversion. I suspect there will be, for instance, and I'm just hypothesizing here. I don't know anything because there might be some Canadians are probably the biggest buyers of US commercial real estate. They may well be on the sidelines for a while. But on the other hand, with the weaker dollar, this is going to present some buying groups in Asia, possibly Europe, with a generational opportunity to acquire US real estate. So it could go one way or the other. But at the moment, I think, there is a pause in the kind of investment market for US real estate. I think it offers an opportunity for private domestic capital, which has been quite active over 2024. I do expect, and it's one of the things that you kind of continuously surprises me about working in the United States. Just how much private capital there is out there. Just how wealthy the society is at certain levels. And, I think it's an opportunity probably, for private capital to, if we do see that kind of easing back from kind of the big institutional investors.
Yeah, I guess consistent with that, the point of view you're expressing is so-called cap rates have remained pretty stable, haven't they? At least so far in all of this.
They moved out when interest rates went up in 2022. They moved up maybe 150 basis points in all sectors, and that is, it's like bond rates. Bond rates go up, bond values fall, and so it's probably seen 25% drop in real estate values. But I think for the last 12 months, perhaps the last 6 months, real estate values have been stable, and cap rates have been stable. And, you know, to the extent that the 10-year Treasury trends back down to 4%, then I think
Right.
cap rates will remain stable. To the extent that the 10-year Treasury goes up above 4.5%, then I think possibly there'll be further value diminution and outmove of cap rates. But at the moment, we're at 4.3%, and you just don't know that that's probably talking about kind of market stagnation, really, with values not neither moving up or moving or down, perhaps gently drifting down.
Yeah, I've noticed the spread between the cap rate and the 10-year yield kind of that has been relatively stable in the last, it feels like in the last several months, despite, you know, everything. And the one argument I've heard is that hard assets and commercial real estate as a so-called hard asset actually do well in this kind of environment. People want that, you know, that steady stream of income that you were talking about, and that's helped to support demand or investor demand, and thus the cap rates have held pretty steady here. Does that resonate?
I think I mean the cap rates are holding steady just because I think cap rates are just a kind of a lagged variable. So
Okay, so we haven't seen, we just too early to tell.
it's too early to tell, but I think the general idea that if we look at previous periods of stagflation, and we'll go back to the 1970s for that. Now we're nowhere near that sort of situation, albeit there is a bit of 70s-like policy kind of entering in. Real estate did very well. You know, I don't know that it's, you know, real estate tends to do quite well where you get high and persistent inflation, and you know people like its inflation. It's not a technical inflation hedge. It doesn't hedge you against unexpected inflation, but it's quite a good long-term capital preserver. It preserves the real value of capital. And you know, I think in turbulent times, with a bit of a whiff of higher inflation for longer, then yes, I think that potentially will motivate investors. I can't say that we've seen it yet, but I think it will.
Well, I want to thank you, Richard, for joining us. That was a very informative conversation, and you know, hang on to that James Bond accent. That serves you well. So thank you for coming on. Really appreciate it.
Yeah, we'll remain shaken but not stirred.
Great line. I think you've said that before. I just have a sense that you've said that before. But anyway, no? Okay, that was a good line. Very good line. And with that, dear listener, we're going to call this a podcast. Talk to you next week. Take care now. Bye-bye.